Welcome to the 13th COVID weekly video with Wayne Michelle and Leslie Cliff, Genus Capital Management. Wayne, I'm not going to waste any time. Let's get right into it. What happened? This market was down this week, but how did you see it?
Well, the market really did well since the economic news broke last week. And a lot of the beat-up areas like the cruise lines and airlines were doing very well. It come back big time. And I think there were a lot of equestrians in that trade, riding that trade all the way up here. And the market, it gets to a level, it hears what it wants to hear. And I don't think the news from Jay Powell was that bad. It was actually as expected. I thought it was bang on.
So what was the news from Jay Powell?
That they're going to have to keep rates low till 2022. The economy is going to take about 2 years to come back. I think the market expects that.
Right. And do you think he was really talking to the government to say, you guys have to do more?
That was part of it. But I think he was just expressing the fact that, and maybe it was a message to the market, don't get too crazy here. We still have some work to do. And the good news here is that he's saying, I'm going to be there with lower interest rates until we get a recovery going. So it was all good news as expected, but that I expected at least. Yeah. And I think most market participants have expected. But the market had gone a long ways and was due for a bit of a breather, and it got one.
Just to remind people, the top of the market was about 3,300. It went down to 2,300. We came back to 2,800, but a 50% retrenchment. And we stayed at around 2,800 for quite a while, and then we bumped up almost to 3,300, and we're back down now to 3,100. So probably wouldn't be surprising, Wayne, in my mind, if we stuck around the 2,800 level for a while.
We have some work to do. It's not going to be a straight line up here. There's still work to do. Also this week, COVID-19, there was some place like Arizona, there was a bit of an outbreak. I went back and checked the overall numbers. If you look at the U.S. overall numbers, they're still coming down. New York is dropping probably faster than Arizona is going up. So overall, there's no issues here. But people are just nervous about any kind of outbreak of COVID-19. It's going to keep happening, I think, as they open the economy up. There's going to be pockets of it, and everybody has to be vigilant. Yeah. And I think the market understands that, is discounting that, and that's why you're seeing economic forecasts taking 2 years to recover where you were back in 2019.
Well, I don't want to beat a dead horse because we probably have covered this before, but the Genus stock signals went positive in April, and they're positive again in May, and they're positive again in beginning of June. So maybe just give us 2 or 3 reasons why they're positive.
Well, the big reason, I'll give you one reason, is the Fed. The Fed has basically pushed money supply up. The global monetary base has jumped like $6 trillion in 3 months. It's amazing. And money supply is jumping at probably around 90% annualized over the past 3 months. They're flooding the system with money. Right. And that's having an impact on all the risk parameters, the risk gauges we look at, like corporate spreads. That's hammering those down as well. So the Fed is a big part of it. Also, the U.S. government's coming in with 44% of GDP spending over the next 6 months, which is helping mitigate some of the risk as well. So the risk alarms are going down and the money supply is going up, and that's kind of what's keeping things buoyant here. And just one comment from Jay Powell said, he was saying, we're not even thinking about raising interest rates. So it's way off.
I also find it interesting that there's been $1 trillion of investment grade debt being raised since he announced that he's buyers of credit, not, he's going to do what it takes to create liquidity through this downturn. The asset managers kind of got in front of him and started buying the high yield, and corporations got in front of him too and started issuing debt. It's actually been kind of a clever communication tool there where he says to the market, I'm going to be buying corporate debt. So the market goes, let's get there before him, and issues the debt, and asset managers buy the debt. And then he comes along. So he's created another $1 trillion of liquidity by just his messaging.
Well, central bankers can do a lot by just jawbone and talking about what they're going to do and get the markets to move in their favor. And the market loves to front run them. So we saw it happen again. You
got to think that Powell's doing a good job here.
Yes, he is. He's got it down. His communication skills have definitely improved from his first couple of meetings.
So I thought what's going on in the bond market, we mustn't ever forget it's the plumbing of what's going on. Just in terms of the Fed issuing more and more debt. And I saw a great chart from a competitor actually that showed the last time we had this kind of debt after World War II, debt to GDP of over 100%, 110%. If you look at what 10-year real return government bonds did post that event, they went down to like -4, -5%. So that doesn't mean the coupon's -4 or -5, but the real return after inflation for 10-year bonds. So that's the way we get out of this. Well, way we got out of this after World War II was to inflate our way out of it, make this debt in absolute terms can't shrink, but in relative terms shrink. Do you think that will happen?
I think they have to generate some inflation, and they have to keep rates low. And they've been trying to get 2% inflation going here, and they haven't been able to do that. And to get 2%, you really have to get to 3% inflation to keep it going. So I can see potentially inflation being 3% and T-bill still being at 0% at some point in time. So yeah, that can happen to get things going, and it's happened in the past, and it could happen again in the future.
The other big thing that's happening that's, I think, weighing on everybody is the unemployment. Yes, it was better in May than April. That came out this week, but it's still 30 million Americans unemployed. And the disconnect to me, and I think to a lot of investors, is a lot of those unemployed people don't work for public companies. They work for private companies. And the percent of the unemployment of public companies is way lower. And so the public companies just aren't in the same mess that Main Street is. Wall Street's doing way better than Main Street. And that's hard for people to understand why this market can go up when the newspaper news is so poor.
That's a good point, because if you look at companies like Facebook, if you look at their revenue per employee, it's massive, and it's all technology, right? And they generate cash flow, and it's having a big impact on their value, and they're not being impacted right now because everybody's on Facebook and because of the COVID. So, I'll just say that the market looks 6 to 9 months forward, and the recession has bottomed. It's starting to improve, and the market's looking forward 6 to 9 months in advance and trying to find the inflection point. And is that inflection point going to beat expectations? Will the economy beat expectations? Yeah. And so the market's probably focusing on sort of a trajectory, like Powell said, 2 years to recover fully. And if we beat that, we can probably go higher. But remember, there have been some big winners in this marketplace. Yeah. We talked in the past of technology and healthcare, consumer staples. Those areas are about 60% of the overall S&P 500. And this scenario couldn't be any better for them. Yeah. Financials are around 10% in the US, more in Canada here, obviously. But the real losers, the airlines, the car rentals, restaurants, that's only about 10% of the overall market. And so really net here for the overall US market, the news has been pretty good.
So bottom line, I think what our clients should know is we're positive on the markets. We wouldn't be surprised if they pause here, but we don't see any any more big air pockets in front of us.
Yeah, the point here is we've turned the corner in terms of the economy. We'll start seeing the numbers improve. The Fed is behind this big time. Don't fight the Fed. And there's going to be a bunch of money spent by the administrations in both Canada, US, and around the world. And so 44% of GDP in the US in the coming 6 months. And there are some big winners in this space as well. And also, I do have some faith in entrepreneurs and businesses, and you're seeing a lot of these resources being shifted in the economy from restaurants going to delivering their cooked meals to homes, these kinds of things. You're seeing it happen in front of you, where the economy is restructuring, reforming to a different way. And cruise lines and airlines are still going to have an impact. Restaurant, if you look at Open Table, for example, restaurants are still down 50% from where they were. Airlines are probably the same thing, still down 50%. It's going to take a long time for them to come back. And people's habits are also changing in terms of we're doing more Zoom meetings, less traveling. So we're accelerating to that digital economy. And because of that, there have been winners, but also big losers.
Yeah. Well, I think that's enough for 1 week. I think what we need to remind ourselves is this is a marathon. It feels like we all want it to end now. It's getting better. So it's like all of us have this emotion to leave it behind. Now it's over. Well, on the weekend in British Columbia, there was a family gathering of 30 people, and 15 of them got COVID from the family gathering. So we need to use, as Dr. Henry says, our common sense. We're in this for the long haul, and it's not over yet, but the markets seem to have recovered. Please call your portfolio managers. We'd love to talk to you. We're afraid to call you because we're afraid we make you nervous if we just call you out of the blue. So please call us, and we'll talk to you next week. Thank you.